Enjoy your meeting.
Yeah, we're getting ready to.
Just a reminder, today's meeting is being recorded.
Okay, we're going to get started here. Good afternoon. This is the Tech Talk Tuesday. Today we want to take a look at what kind of damage the last few days of selling has done, and whether or not we're going to get a retest of the August lows or perhaps possibly make a new low, which is very possible at this stage. Also, we'll take a quick look at some of the sectors, see which ones are holding up the best, so you'll know where you want to put some money when this thing does finally find a bottom. Finally, we're going to take a look at some of the ETFs at the ETF Center just to see if we can gain some exposure to global markets. So far, they've been the markets that have kind of led the way down. We were holding steady for most of the year. We're trying to play a little bit of catch up now. We'll look at some of the different markets that are making that are already in bear markets overseas, and find some ways to look for markets that may have already bottomed over there. Okay, last week the major averages broke below a bearish rising wedge pattern that we had been talking about for the last couple of weeks. I pulled up the first chart here of the Dow Jones. Right here on the right, you can see that rising wedge over here, and where we broke out of that last probably like Tuesday or Wednesday. Internal breadth was weak last week. We had the NYSE and NASDAQ advanced decline lines both deteriorated. Number of new 52-week lows started to expand. Last Thursday we had 357 new lows. That was the highest since the August 24th sell-off. Most of the underlying indicators also were bearish last week. Sectors were mixed. We had a little bit of strength in utilities, the consumer staples, and financial sector, and that was offset by weakness again in materials, industrial sector, and also the healthcare sector. With all the biotechs selling. What we're going to take a look at right now is take a quick look at the four major indexes. Here's the Dow, as you can see over here on the candlestick chart. A pretty ugly day yesterday. The very bearish candlestick stick started at the top and just continued lower throughout the day. This chart looks like we're definitely going to go down here and test this reloads. Probably around the 15.3 area. Now you can actually do a measured bottom if you measure from here to this part where the rising wedge started. If you take that and bounce it off of this, that's where the measured move is going to come in down to about the 15.3. It's a measuring indicator that we can use just to see what's going on with this. Okay, now the S&P 500. You can see on yesterday's move, we've almost made it back to the August 24 low down here around 1865, I believe. Today we're up about 3 points. Not sure if we're going to be able to finish positive today, as the advanced decline lines are already more negative than more decliners than advancers. Okay, we do a measured move off of this pattern. You're actually probably going down looking at about an 1820 on the S&P. That would be that would be right around the October 2014 lows over here, where we bottomed out. If for some reason we would really get intensify the selling again, the measured move actually would take you down to around 1740, and that's actually where the February 2014 low was. But I would expect to see buyers come in if we break this 1865 over here before, probably come in around 1800. Goldman Sachs yesterday lowered their target for the S&P 500 yesterday to about 2,000 through year end. I think they have 2,100 for 2016. That's only a 5% rise next year. However, if you can get in here around 1,800, if we get a pullback to that, and we do make it back to 2,000, that would give you about a 10% move off of the bottom for this year. Okay, the next one I want to look at is the NASDAQ. It's holding up a little bit better. I'm actually going to show you two charts on the NASDAQ, partly because of the poor opening on the August sell-off. I'm not exactly sure if that would should have gone that far. Well, that was because of some of these ETFs and all that had the openings, but there really wasn't a bottom in it. But this looks like we're at least going to go down here and test this 4480 area. The indicators here, you can see the momentum indicators down here on the RSI, and even on the short-term MACD have gone bearish. And yesterday we also got the infamous death cross from the 50 crossing the 200-day on this also. So that was the last index. It was kind of holding up, but it doesn't look like it's going to be able to hold. I've made this a black background because I want to see if I wanted to use a line chart versus a bar chart, because sometimes it's easier to tell the actual patterns. These are closing prices. As you can see, yesterday's close, we almost hit this August 24th low. That would be something we're going to watch over here, right around the 4,500. Today we're at 4,554. We're up about 10 points. So again, we're almost ready to go negative on the Nasdaq and also the S&P. We'll see if we can hold today. Dow's up about 11 points right now. Okay, the Russell 2000 yesterday. This is the first index that actually broke the August low. Okay, the next support for the Russell 2000 is going to be down here at the last October 2014 lows. That's going to be around 1050. The fact that some of the other indexes are already testing this lows, this is showing some negative divergence for the broader market. We always talk about what the positive and negative divergence are precursors for what the Dow might do. This is indicating that for sure we're probably going to go down and retest that lows. Okay, before we look at the sectors and talk about some of the global ETFs, I want to quickly look at some of the internal breadth numbers. We show this every week. Here's the NYSE advanced decline line. We talked about we were actually seeing some positive divergence in this, but the last couple of days we're down here retesting the lows. So we're getting ready to go back into lower highs, lower lows. And we actually have more decliners today on the New York currently than we do on the for the rest of them. And actually the Dow just went negative again right now. Here was another one, the NASDAQ advanced decline. We saw some positive divergence in here. We were hoping to get a run up in this area, but this selling in the biotech arena just took that thing to the tool shed, and we've actually made a lower low, and we're making more lows today. So again, note the positive divergence that we saw earlier has gone. Also, I want to talk about new 52-week lows we saw yesterday in the NASDAQ. We had about 334 advancing issues. No, it was in the New York. We had 334 advancing issues to about 2,800 declining issues. We also made 493 new lows to only 5 new 52-week highs. That's the biggest number we had since the August 24th low. And also on the NASDAQ, you had, I think you had 360 new lows on Monday, and that was versus the 770 you had on August 24th. Okay, we're going to jump over real quickly to some of the sectors just to see what's holding up the best. Again, I put the line chart on here because of that opening that we saw on August 24th. Some of these ETFs just got crunched. They were down like 20-25% on the open, which wasn't indicative of actually what the market is. Okay, so here's the energy sector. We're officially in a bear market on this. It's been moving lower for over the year. This sector's down 41% from its high, and I don't see anything on this chart quite yet that says we're near a bottom. We've been telling you to stay away from these from the energy sector for a while. Here's the longer-term chart on this. You can see going back to 2009, we broke a multi-year low or multi-year trend line, and that when you see something break a trend line, a multi-year trend like this, that usually is telling you that something fundamentally has changed. I would expect this. This is telling you that possibly we might even see energy break back down into the 30s. 45 has been the real line in the sand here lately. If it can hold that, that would be great, and maybe we'll start to see a little bit of sideways motion in here. But at this point, if you're buying the energy stocks and oil stocks, it's mainly just for an oversold bounce. I would sell the rallies and look to maybe buy them later on. Okay, an even worse looking chart lately. Here's the materials spider. This is also in a bear market. This one's down 25% from the highs. It's making new lows. the one difference on this, the indicators over here are really oversold. I think the RSI down here is around 10 or something like that. So this may, you could probably get a little bounce in this. But one thing at this point, this is also points to the global sell-off in the commodity prices. You can see until we see some bottoming in this thing, you're not going to get much of the emerging markets moving around on that. Another look at the longer term on the materials. Here you see we see it breaking through a multi-year trend line on that, and again we're still made another new low today. Today it is. Look here. It's getting a little bit of a bounce today, up 14 cents. I wouldn't really call that a bounce. So that's another area that unless you're buying something like the copper or something like that just for a very oversold bounce, I wouldn't be looking to put big money in that for longer term fees right now. All right, here's one that had been looking great. We actually got the death cross in this yesterday also. The healthcare sector is actually down. I think it's okay. We're down about 17.6% from its high. We're not in bear territory yet, but actually we're right over here. We're down almost 11% in a week. So that's again, this is a sector that's very oversold. You're going to get bounces. You actually had a little bit of a bounce today. That sector's up 1.4% as I'm talking right now. So that's just an oversold bounce. I'm not sure I'd be jumping in there quite yet, but again, longer term, I think we'll see something. That is a place we want to be. Okay, next one here is the industrial sector. Again, we took out the August 24th low in the industrial sector. Okay, this has companies like GE, United Technologies, Caterpillar, and these companies have just been crushed lately. Part of that is because a big portion of the revenues come from overseas, and with a strong dollar and possibly even a stronger dollar if rates get hiked, you're going to want to steer clear of the industrials. You can see we already took out the October low of last year on the industrials already, so we probably have a little bit lower to go on that. Okay, just for a quick wrap up on that, I don't have charts for the rest of them. I want to keep this short, but the financials are down about 13.5%. I would be looking to buy the financials once this market begins to try to put a bottom in. Rising rates are good for the bank and insurance stocks. The consumer discretionary stocks are down about 10.2%. That includes retail stocks, footwear like Nike, Under Armour, home builders in that sector. Although the charts on some of the home builders are starting to show some deterioration. I know some of them have already taken out, like Toll Brothers have taken out some of the August lows. Pulte Homes actually did a double bottom yesterday, but they look like they're starting to roll over a little bit. So I would keep an eye on that. Also, let's see, the technology sector, we're down about 14% on that. Still holding above the August lows, but we're getting some additional selling in the momentum stocks like the Facebooks, Netflix. Netflix off about 20% from its high. I think Facebook's gone down about $6 or $7 from there. Another place where we're seeing some on one of the indexes, we're seeing some divergence. The Philadelphia Semiconductor Index actually has been holding up a little bit better in here. You might look at a stock like Intel. It looks like it may have bottomed in here around 26, 27. Some of the other ones, I think Altera. Actually, Intel bought Altera. Never mind on that. But also, then the last one would be the consumer staples sector. It's down about 10.4%. That's also a place that will probably outperform once the bottom is found in the market. If you're still want to stay defensive over the longer term, those stocks pay good dividends, and it's a good defensive area. Okay. A lot of times on this Tech Talk, we talk about other markets that we're looking to show signs of bottoming before the actual S&P 500 or Dow bottomed. That's because there's usually somewhere that you can find a bull market if you look hard enough. I don't care what's commodities or emerging markets, oil, something. If you're able to spot some of these leaders, you can help position yourself to get in ahead of the crowd. We're going to look at here's the industrials on the longer term. Okay. We have what we call, on the Market Edge website, something called the ETF Center. ETFs are allows you to get some global exposure to different countries. You can buy into commodities without going to the futures markets, whether it be oil, copper, whatever. But there's a few things you might want to know about before you jump into some of these global ETFs. First of all, you can buy an ETF that would be like developed countries, which would be the whole European countries. But then again, why, not all countries are the same. Why would you want to invest in a fund that holds Italy and Spain and Greece? And perhaps you could just buy France and Germany, which are showing some signs of some rebounds. So by buying some of the global country ETFs allows you to buy, pick the best of the best of which countries or continents even that you think might not be having a slowdown. You like say you buy Germany, not Greece. Maybe you buy South Africa, not Nigeria. I'm going to switch over here real quickly to show you the ETF Center, so you can find it. We're going to look at some of the different ETFs there. Let me go to the screen sharing thing here. Where at? Up here? That? Okay. Sorry. Wow. Okay. Okay. Now, hopefully, you can see the. Hopefully, you can see my screen now. So when you go into your Market Edge site and you click on. Slow down. Let it catch up. Okay. All right, here, okay, now you're in. Okay, if you go up here and click on ETF Center, we've broken down the different categories, the ETFs into different categories, which include, emerging markets, the different sectors, currencies. You can even look at the shorts. You can go into style of investing. Those are just small caps, mid cap, large caps, blend, value, growth. And this will allow you, if you click on something like this, if we go into Europe, it's going to give you a chart of here's the S&P 500, and here's here's Europe with the broader countries. However, I mentioned earlier, if you go in here, this will give you what ETFs are outperforming the broader market. Right now, unfortunately, most of them are avoids, but we do have a little bit of a pickup in iShares in France and Belgium. Actually, Italy is showing a little bit of positive divergence too. So this will allow you to look at individual countries when you're trying to find something that's gone to a bottom. Now we talked a little bit before where there's always a bull market somewhere. You look at the shorts. Let's see here. We had YANG. I don't see. Okay, most of the shorts are long. There was. I was actually looking at saw one earlier here on the smart chart. Came up. It was YANG, and this is the triple short China bear thing. Now I noticed on the second opinion, this thing actually went to a short back here in June, or to a long on it back here in June at around $63. We're up over here at 120 right now. Yesterday you had a double point figure breakout to the upside. Over here, so these would be areas that you can actually go into to find some. Looking for my notes here to find some of the bull spots while we're until our market actually finds a bottom. That's going to do it right now because we're trying to keep these things to about 20 minutes. What I want to try to do here is actually just. If you have any questions that you'd like to bring up about individual stocks, if you want to, a broader market, anything you want to do, just type in the little chat box here in the bottom, and you can ask me something. We have a couple in here. Let's see. Energy, materials, industrial, stay away. Any place safe other than cash? Well, right now that's kind of a good thing. What I recommend at this point, you see some of these sectors that are outperforming, like the financials are acting a little bit better, the consumer staples, consumer discretionary. what you want to do is you kind of have a target in here of places where you think the market's going to bottom. And those sectors are that are outperforming now. Those are the places where you want to have some money lined up. Supposing you come in here and you look at companies in the financial sector like Prudential Insurance or Wells Fargo or J.P. Morgan. You can look at those charts. You're going to find what's been holding up the best. Stocks that are holding up the best while we're rolling over are the ones that will outperform going forward. So if you look at the Nikes, the Under Armours, and the consumer discretionary markets, you look at those areas. That's where you want to look to buy when you actually see a double bottom go in here in this market, or you start to see a rounding bottom, whatever. We looked at some of the different bottoming techniques to spot a bottom last week. This is where you want to put your money. Okay, when the Fed raises interest rates, will the CTI be restored? Okay, Mark is talking about the cyclical trend indicator. It was a cycle analysis that we used on the Market Edge site for about 30, 35 years, 40 years. Actually outperformed the Dow, got you in when the cycle was beginning, got you out when it was weak. The CTI had a 4-year business cycle, which was one of the major cycles in it. And back in 2008, when it went back to zero interest rates, that pretty much destroyed any kind of business cycle that you had. Until we've been keeping track, but it's been wrong. We're not going to put something out there that's going to be dead wrong for you. So until we actually see the CTI begin to outperform the market again, that's when we'll put that up. Hopefully we start getting some normal business cycles soon. But until that happens, we're keeping track, but it's not doing much of anything at this point. Any other questions? We look at some individual stocks if you'd like. Usually I do pull up some individual stocks that we look at. I'm not doing that the last couple of weeks just because it doesn't make sense to be telling you to buy this stock or that stock when we're telling you that the market's probably going down another 500-600 points. Okay, we got somebody else coming in with a question. Somebody was typing. Now they stopped. Okay. Okay. Could you comment on the strength index? All right. The strength index is published weekly in the Market Edge weekly commentary that I do, and what that shows, the strength index is a accumulation indicator, and what we're looking at is sometimes you can see the market going down. The market goes down 700 points, but all of a sudden you'll start to see the strength indexes beginning to go up. Again, that's a sign for positive divergence. What that shows you is maybe at first you had 20 of the 30 Dow stocks going down. Maybe now you only have 12 of the 30 Dow stocks going down. And what that'll show is that we're starting to get more, people aren't just selling at random. They're actually buying some stocks as the market begins to fall. So when you start to see the trend in the strength indexes, the turns, that's when you start to look at possibly we might be at a bottom. I just did them today, and they all had slipped back into negative ground over the last 5 days. So that also is a little bit confirming indicator that we probably have a little bit lower to go here. We got another one coming in. Okay, where do you think the Chinese market is heading? Well, we're already down about 40%, so I'm not sure. I will tell you this: on some of the markets, if I could look at the myself real quick, I want to see. Okay, I do see some positive divergence, and it's very possible that the Chinese market is trying to put in a bottom. There's an ETF called the Morgan Stanley Chinese Fund. The symbol is CAF. It bottomed back here on August 24th at around $18-something, $19, and we've been trading at around 21 3/4 to 22 1/4 now for about a week and a half, 2 weeks. That's a good sign. You are actually battling the 50-day moving average on that fund. I think it's like 21.15, If you can see that CCAF, go above that, you can get a run back up to around $26. That's $4. That's about a 10-15% on a bounce. Again, the market's now 41%. It's got to bottom somewhere, and I believe that the Chinese market is showing signs that a bottom is in. If we can cross through this 50-day moving average, that's a bullish sign. Okay, I don't see anybody else typing right now. So I guess, like I say, we try to keep these things at 30 minutes, not give you too much information, but something that you can use over the next week. And then we kind of, if you read the weekly market commentary, we wrap it up and give you some more ideas going forward. So I'll stop this recording right now. There should be another link up on the site, probably within about an hour, hour and a half, if you want to look at some of the other charts that we put up. Thank you for attending, and we'll talk to you next week.